Beyond the problem of manipulation in the order book and the problem of ambiguity due to the diverse nature of market participants, we also have the problem of hidden volume. Hidden volume occurs primarily due to OTC, or over-the-counter trading, and dark pools. OTC trading is when trades happen between certain parties without going through a centralized exchange. This is a problem, of course, because it can obfuscate the real level of market activity to the general public. This is not a small matter since OTC trading is usually done by large players such as pension funds, hedge funds, sovereign wealth funds, and very large companies. Just so you can have some perspective, the volume traded in the OTC markets is a few times larger than the global GDP. In 2023, it is estimated that the global GDP was around $100 trillion. The volume traded in the OTC derivatives market alone was $600 trillion, according to the Bank of International Settlements. Dark pools are private off-exchange trading venues where large institutional investors can execute trades without publicly revealing their orders until after the trade is completed. Dark pools are primarily used to minimize the market impact of large transactions. The lack of pre-trade transparency is clearly a problem if traders are looking to analyze the real-time order flow of a market. In summary, the manipulation in the order book with the tactics such as iceberg orders and spoofing, the ambiguity generated by different kinds of market participants such as speculators, arbitrageurs, and hedgers, and the lack of transparency due to OTC and dark pools, hidden volume, lead us to conclude that the real-time analysis of order flow done by retail traders is mostly a vain exercise. Given that trading is a game of asymmetric information and retail traders are always on the weaker side, we need ways to analyze order flow in a more concrete way. In other words, we cannot rely on tools that show real-time intent. We need to rely on tools that tell us what in fact happened with the order flow. One of these tools is what is called time and sales, also referred to as the tape. However, things happen too quickly in the tape. It's a difficult tool to use, and there are better options for analyzing the historical order flow. The conclusion here is that we should focus on tools that highlight important aspects of historical order flow. That solves the problem of dealing with manipulation tactics in the order book or DOM, such as layering, spoofing, and iceberg orders. Historical order flow tools will show us what in fact happened, not the misleading intention of various market players. However, by using historical order flow tools, we still have the problem of ambiguity and the problem of lack of transparency or hidden volume. The problem of ambiguity can be mitigated by changing our perspective. Instead of looking at order flow as a tool to identify directional movement, we look at it to identify levels of activity. The problem of lack of transparency still remains. One way of dealing with this problem is to focus on futures trading because futures are traded on centralized exchanges, unlike Forex, for example, which is decentralized. You can read order flow in currency futures to obtain more transparent information and trade on Forex charts, for example. In conclusion, use historical order flow tools. Focus on identifying levels of activity instead of identifying directional intent, and focus on futures trading if you want to obtain more reliable order flow data. There are many historical order flow tools, but we'll focus on 3 of them for simplicity's sake: the footprint, the volume profile, and the cumulative volume delta. Let's begin with the footprint. The footprint shows the same information given by the time and sales or tape, but it displays it in a useful and relatively easy way to observe. Once again, the idea is not to identify directionality, but to quantify the activity of buyers and sellers in the price levels within a candlestick. Recall that when we looked at the order book, we were analyzing limit orders, limit buy orders in the bid and limit sell orders in the ask. Those were the real-time orders of the market. The footprint is a historical order flow tool, meaning that it shows the orders that got executed, not the orders that might be executed. In this sense, the bid and ask columns of the footprint demonstrate aggressiveness, meaning that the bid column shows selling aggression and the ask column shows buying aggression. That might seem confusing, but you must remember that an aggressive order always matches a passive order. In summary, the bid column shows passive buying intent in the order book, but in the footprint, it shows the aggressive selling that actually took place. The S column shows passive selling intent in the order book, but in the footprint, it shows the aggressive buying that actually took place. When buyers attack sell limit orders, this activity is represented in the S column. When sellers attack buy limit orders, that activity is represented in the bid column. Make sure you understand this perfectly. Before we move on to the features of the footprint chart and how to use it, let's make sure we clarify a problem related to the matching of orders. Let's go back to the simple example of a long trade with the stop loss and take profit target orders and analyze where each of these three orders will appear in the footprint. Imagine that you open a long trade with a buy market order. That is an aggressive buy order, so it matches a sell limit, and therefore it will appear on the S column of the footprint. If your trade gets stopped out, a sell stop order will be triggered. A sell stop order is a sell market order that matches a buy limit order, and therefore it will appear on the bid column of the footprint. The take profit is a sell limit order that, if triggered, will match a buy market order, and it will appear on the S column of the footprint. Imagine now that you open a short trade with a sell market order. That is an aggressive sell order, so it matches a buy limit, and therefore it will appear on the bid column of the footprint. If your trade gets stopped out, a buy stop order will be triggered. A buy stop order is a buy market order that matches a sell limit order, and therefore it will appear on the S column of the footprint. The take profit is a buy limit order that, if triggered, will match a sell market order, and it will appear on the bid column of the footprint. It's key to remember that not all aggressive orders have intent of adding buying or selling pressure to the market. For example, the stop loss of a sell, which is a buy market order, can match a take profit from a buy, which is a sell limit order. This will appear on the ask. Both traders are leaving the market, and yet the footprint would reflect aggressive buying in the ask. The stop loss of a buy, which is a sell market order, can match a take profit from a sell, which is a buy limit order. This would appear in the bid. Both traders are leaving the market, and yet the footprint would reflect aggressive selling in the bid. With that in mind, let's begin understanding the features of the footprint chart. The footprint chart shows two columns, one in each side of the candlestick in question. You can change the level of resolution of the price levels according to your liking. The column on the left shows the bid volume across different price levels of the candlestick, recalling that on the footprint, the bid column shows selling aggression, not buying intention, like in the order book. The column on the right shows the ask volume across different price levels of the candlestick, recalling that on the footprint, the S column shows buying aggression, not selling intention, like in the order book. It's a mistake to associate red cells with directional selling only and green cells with directional buying only, as we saw previously. The cells with lighter colors show price levels with lower volumes, and logically, the cells with darker colors show price levels with higher volumes. The cells in black demonstrate the price level with the highest level of activity. This is known as HVN, or high volume node. This can be useful when trying to judge which price level within a candlestick future price action can react to. If this was the price level with the highest volume, is the price where buyers and sellers found fair value for the most part, and it can be used later as support or resistance. Another feature of the footprint is called the value area. As a default, the value area is the range of prices where 70% of the volume occurred. This level of 70% is not arbitrary. If we recall the empirical rule in statistics, we see that 68% of the data occurs within one standard deviation from the mean in a Gaussian distribution. Traders simply round that number up to 70%. This is therefore the range of fair value within the candlestick. The high volume node is simply the peak of the distribution within the value area. The limits of the value area are displayed as VAH, which means value area high, and VAL, which means value area low. This is the same idea of the volume profile, but instead of measuring the volume distribution in a series of candlesticks, the footprint shows the volume distribution within the candlestick. Another important feature of the footprint is called imbalance, which is highlighted by green or red thin bars on the side of the price levels where the imbalance occurred. It's important to note that we don't compare price levels horizontally in the footprint. We compare them diagonally, like so. That's because when buyers attack passive sellers, they do that one price level above. When sellers attack passive buyers, they do that one price level below. As a standard, the imbalance occurs when there is a 300% discrepancy between price levels, meaning when one price level has at least 3 times more volume than the price level immediately above or below. When the discrepancy occurs in the bid, there is a bid imbalance. When the discrepancy occurs in the ask, there is an ask imbalance. The terms buy or sell imbalance are not really appropriate because not every selling aggression comes from sellers willing to add selling pressure. Not every buying aggression comes from buyers willing to add buying pressure, as we saw before. In this candlestick, we have 3 imbalances in the ask and 1 in the bid. Let's analyze the highest one in the ask. We see that in the imbalance level, there is a volume of 24,000 in the ask. One level below in the bid, we see that the volume was 6.9 thousand. If we measure the ratio here, we'll see that the ask volume was 3.46 times larger. That is why this is marked as an imbalance. If we look at the bid imbalance at the top, we'll see that the bid volume was around 17,000 in comparison to 2.6 thousand in the ask. That's 6.5 times larger. Imbalances can also be stacked. For example, when there is more than one imbalance in successive price levels, we have stacked imbalances. Another important feature of the footprint is the volume delta. The delta is nothing more than the difference between ask volume and bid volume. Generally speaking, bullish candles have positive delta and bearish candles have negative delta, but not always, as we'll see in a moment.